Hello, everybody. This is Professor Hassey. It's Sunday, July 16th, and today is our weekend video for week number 6 of Accounting 203. Hope everybody's doing fine. I have posted the grades to assignment 3. They are in Blackboard, and I will be reviewing that assignment in this video. I'll be introducing assignment number 4, which has been posted to Blackboard and is due on Sunday, July 23rd. And we'll be introducing accounting controls from Chapter 8, which will be not in assignment number 4, but will be included in your final examination work. All the while, you are completing your project paper on the company that you selected and analyzing their 10K financial statement. A couple things to review in regards to assignment 3. Those solutions are here, they are in front of you, but they are posted to the assignment 3 file folder, and I urge some of you to review them. Again, you're going to see some of these questions on the final examination, and this will be your reference guide to that. I should talk about the final examination, which will be posted next weekend and due on July 30th. Final examination will mainly be on the second half of our course, retail inventory, cash and accounting controls, plan assets, and managerial accounting. But there'll be a couple of questions on the accounting cycle. So this assignment number 3 was us wrapping up the accounting cycle. And I'd ask you to prepare for 2 companies in an adjusting entry, prepare the adjusted trial balance, and then prepare an income statement, a statement of owner's equity, and balance sheet for Glow Styling. And then I ask you to do the closing entries for Paradise Travel based on the adjusted trial balance that I gave you, the closing entries, and then the post-closing trial balance. One of the things you have to remember when you're doing adjustments is you have to adjust the accounts to your trial balance after you make the adjustments. And this is where some of us had some problems as far as doing the adjusting entries. Everybody did pretty well on it. I think a couple of areas, and you can go through these on your own. Couple areas where some of us had some problem was, for example, in letter B, an inventory count showed that $210 of unused shop supplies were still available. Well, if you look at the unadjusted trial balance in that problem, it shows that shop supplies had $990 in the account. Well, in the adjusting entry, they tell us that 210 of that is still unused, meaning you still own them. So the adjusting entry is to debit shop supplies for the difference between 990 and 210, $780, and credit shop supplies $780. If you do that and you post that shop supply credit of $780, the shop supply balance in your adjusted trial balance will now be $210, the correct amount of the inventory. Another problem area was letter E. A beautician is behind on space rental payments, and this $200 of accrued revenues was unrecorded at the time the trial balance was prepared. In other words, $200 of revenue accrued, meaning it's been provided, but it has yet to be paid. So in E, you have to debit rent receivable for $200 and credit rent earned. So when you see the word accrual, it means the service, either it's expense or revenue, in this case, a revenue, that service has been provided, but it remains unpaid. If you have provided the service of rent, then it would be rent receivable and credit rent earned. And then finally, letter F, $800 of unearned rent account balance was earned by year end. Well, if you look in the unadjusted trial balance at the beginning of this problem, you see that unearned rent has a balance of $1,600 on the credit side. In transaction E, F, they're now telling you that $800 of that has been earned. So you're going to debit the unearned account $800 and credit rent earned $800, showing that that amount of rent that was paid in advance now has been earned and can be recognized as rent earned in revenue. Notice the unearned rent account, which had $1,600 in the unadjusted trial balance. You have to make sure you account and post that unearned rent balance of credit 800 to now bring the unearned rent balance to $800 credit. Some of you did the entry correctly, but you didn't post it as an adjusted trial balance, and that's what you need to do. So if you do all those entries, here's the adjusted trial balance, 135.9 on both the debit and credit side. And then you take all the revenue and expense accounts on this trial balance and put them in the income statement, and you get a net income of $12,120. Then you take the owner's accounts, the capital balance of $49,860. There it is right there on your trial balance. You add in net income, and there's no withdrawals or dividends in this problem. So the ending capital balance is the capital balance plus the net income, 61,980. Then you take that 61,980 and place it in the balance sheet, and you put together the list of assets. Notice shop equipment, 3,860, less the accumulated depreciation, which is a credit balance, 2,740. The building, 57.5, less the accumulated depreciation, 51,440, giving a $114,030 asset balance on the balance sheet for Glow Styling. Then you have your various liabilities: unearned rent, long-term notes payable, wages payable, property taxes payable, interest payable. That plus the liability, the capital account from your capital statement, equals 114.30. So that's what I was looking for to Glow Styling. Each problem 1, Glow Styling, is worth 50 points, and problem 2, part 2, Paradise Travel, is worth 50 points. Then in Paradise Travel, pretty straightforward. I give you the trial balance, 135,260, and then you are to prepare the closing journal entries. In other words, zero out the temporary accounts of withdrawal, fees earned, and expenses, and you close those out to the income summary. So fees earned are debited, 75,000. Income summary is credited, 75,000. Income summary is debited, 60,360, and all the expense accounts are credited to zero them out. And then the difference between income summary, or between the credit balance of 75,000 in income summary and 60,360 debit balance in income summary, is your net income. And income summary then is debited 14,640. That's our profit, which zeroes out the income summary account, and you put the credit into the capital account. And then the withdrawal account of $1,000 is credited, and it's to put immediately as a debit to the capital account. So if you do all that, the ending capital balance is 43,900. And then you list the remaining accounts, the permanent accounts of this system, assets, liabilities, and capital, $73,900. So remember, the income summary account is used in the closing process to flow through the revenue and expense accounts to zero them out. Now Paradise Travel can begin January 1 of the next year with zero balances and withdrawals, revenue, and expense accounts, and they continue the process of the business. So that's what I was looking for in assignment 3. Please review, because you'll see a couple of questions on this on the final. Here is assignment number 4 that's been posted this weekend and is due next Sunday, July 23, where I'm asking you to do 2 sections or 2 problems involving retail accounting that we discussed this past week. I'd ask you to do the journal entries of this company from May 1st to May 17th. Do the recording journal entries. We reviewed this in our last video. And then I want you to do the fill in the blank of the income statements. In other words, here's the income statement for a Corman company. I want you to tell me what is the unknowns here. Try to figure out what is A, B, C, D, and E. Those are your unknowns. You got to find those five numbers, excuse me, A through C. So find those based on the information given to you in this income statement that's unknown. And then finally, in question 2, I'm asking you to determine the ending inventory using FIFO and using LIFO in this example. There is no spreadsheet provided for this, so probably you will have to do and create your own spreadsheets with the journal entries and make the answers. Or if you like, on a separate piece of paper, write down or type them out in a Word document or a PDF document and do your answers. Remember, don't do your answers by writing them out on a piece of paper and then taking pictures of them on your phone and send me the pictures of your work. All the work has to be digital. So either you do it on a spreadsheet, you do it on a Word or PDF document. Either way, it's got to be digital. All right, so that's for you to sort out at this time now. After going into 6 weeks of class, you should be able to organize your accounting answers into a document after we've practiced them in these other documents and spreadsheets that I have provided. So you prepare based on your format of selection. Journal entries, fill in the blanks, 1, 2, 3, 4, 5. Tell me what the FIFO ending inventory is and what the LIFO ending inventory, and we reviewed this in a prior video. That is assignment number 4, your last assignment for the school year, for this summer. The 2 remaining works after this are the project paper and the final examination, which all will be due in 2 weeks on July 30th. Any questions on this, please let me know. So here's our Blackboard account. Remember, your assignment 3 solutions that we just went over are right here in the assignment 3 file folder. I've posted and returned your file for assignment 3 to your grade center. Assignment 4 in 2 formats, the same work, PDF and doc, that is due next Sunday, which we just saw. This is you select the format and the worksheet that you do it on. It's you set that up however you think is best in your way to answer those questions, but do not take pictures. All right. You have your project paper due on July 30th. And now what we're going to talk about is agenda for our week 6, and we're going to talk about accounting controls. One of the most important accounting controls you can think of is a bank reconciliation. Make sure that what you have in cash matches what a third party or your bank says. This is one of the most important things that a business can do. It tells them that they got everything organized within their business, control-wise, and it also tells their community, their investors, their vendors, that they got their act in gear and that they know what they're doing. So let's take a look at accounting controls. Now, the last item for this week's lecture is Chapter 8, and it's called Accounting Controls. Understanding how to balance your checkbook. I'm sure a lot of you, as good personal financial managers, you balance your checking account every month, making sure what the bank says you have equals what your cash or checking account balance has in your checkbook. It's called balancing the accounting, balancing the checkbook. Well, businesses, this is very important because it shows the market, it shows bankers, it shows people that you are efficient. You can control your information and balance it. A lot of banks will not lend you money if you don't have good accounting controls. Accounting controls is like reconciling your bank account, making sure you keep all the receipts and all the transaction records. If you don't do that, you're sloppy, and a lot of people aren't going to do business with you. So in Chapter 8, they're talking about an example of a bank reconciliation. So here's a company's bank account and their cash ledger balance on July 31st. They have $27,233 in the bank. They have $27,497 in their cash account ledger balance. So what you do now is you reconcile. If something appears on the bank statement balance or bank statement that is yet to appear in your cash account, you have to reconcile it. If something appears in your cash account but has yet to be involved in your bank statement, you report it over here. Example, in my $27,497 cash balance are 3 checks that I have written that have yet to clear the bank. They haven't cleared the bank yet. Check 3031, 3065, and 3069. So these checks have been deducted or credited to my cash account, but the bank has yet to see them. It's not in that balance. So I have to deduct them from the bank balance to show that eventually they're going to clear the bank. It's called outstanding checks. So the total of these $4,145 is the reconciliation balance, taking them out of the bank account to match the cash account. At the same time, at the end of July, this company deposited $11,514 in this balance. But on the bank statement of July 31st, that deposit had yet to show up on the bank. Did you ever take a deposit to your ATM machine or to a bank and you deposit it and it says those funds are not going to be available for 24 hours? That's exactly what that is. It's called a deposit in transit. So since this $11,514 was included in this balance, I have to add it back in as a reconciliation item to my bank balance. I subtract out outstanding checks. I add in an outstanding deposit. There's my reconciliation balance of $34,602. Now, what information appeared on the bank statement that has yet to appear on my cash account? I wrote a check number 3056, and I made an error. I said when it cleared the bank, I made an error of $20 on that. I made an error. I goofed. I wrote it in the bank balance, in the cash account balance, $20 less than what it actually was. So I have to subtract $20 from my cash balance for that error. At the same time, in the deposit made to the bank statement, $805 was a bad check, an NSF check, non-sufficient funds. So in other words, we deposited money into our cash account, and then when we got the bank statement included in this, they deducted it from our balance because it was a bad check. So I have to deduct this balance from my cash account for being a NSF, a bad check. At the same time, on the bank statement, they told us that we had a $25 bank fee during the month of July. I did not know that until I saw the bank statement, so we deduct $25 from that. Also, we saw in the bank statement that the bank collected a note for us for $7,955. We didn't know about that until we saw it on the bank statement, so we have to add $7,955 to our balance. And look what happens. We subtract the error of the check. We subtract the bad check. We subtract the bank service charge. We add back in the note, and look what happens. We now are balanced. This is now called a reconciled account. The cash balance reconciles to the bank balance. All these transactions will clear the bank eventually, and I'm going to have to do a adjusting journal entry here to get these changes in my cash account balance because of this reconciliation. You don't have to do a journal entries here because these will clear through the bank. They're already included in this number. But I have to make adjusting entries to record the note collection, debit cash, credit receivable, the $805 bad check, putting it back on receivables and reducing cash, the error on the check, which was for rent, debiting rent expense and crediting cash, and the miscellaneous or bank service charge, $25, and credit cash. Notice for deductions here, I'm crediting cash, and for additions, I'm debiting cash. I post these adjusting entries, and they now make this balance match the bank adjusted reconciled balance. You have to do this every month, because when you're audited by your public accountants, when potential investors want to see your accounting controls and they say, all right, show us your latest bank reconciliation. Huh? We didn't do it. Well, that's not going to make your efficiency and your company look very good. Thus, you reconcile it. Okay. So that finishes up our week 6 update video. We've reviewed assignment 3. We've looked at our assignment 4 work for this week about retail journal entries, financial statement, and inventory valuation. We've begun our discussion about accounting controls, looking at bank reconciliation. And in our next video on Monday, July 17th, we'll take a look at accounts receivable and plan assets and our topics for this week, along with liabilities and stock equity. That's our topic for week 7 this coming week. Have a great week, everybody, and we'll see you all on Monday, July 17th. You have some work to do this week. Any questions, be sure to let me know. Until Monday, adios.